we look at the various regions of the world that you can invest in. 2021 is a fairly critical year for the world markets, not only because we are emerging from the pandemic, also because we are turning into a new economic cycle more than 10 years after the 2008 global financial crisis. I present to you, ladies and gentlemen, Colin Low, Senior Research Analyst from iFAST Financial Singapore, who will present our global outlook. Time permitting, Colin will try and take a few audience questions as well. So please put in questions using the Q&A button that you would like Colin to answer. Over to you, Colin.
So apologies, everybody. So now, right now, I think I'll properly begin with the outlook. So I think there is some technical difficulties right now. So I am Colin, the Senior Research Analyst from the Macro Research team. So at iFAST Singapore, so it's my pleasure today to talk about the global equity outlook for 2021. So next slide, please. So let's start off right now with painting the macro view. So it is our belief that right now we are in the early phase of the business cycle. So what that means is that we have indeed passed through the trough and are stepping into a global cycle recovery. I think like what Gavin, the presenter earlier, mentioned. So I think perhaps the biggest evidence for this is that this if you look at the global manufacturing PMI, which itself is a cyclical leading indicator, so you can take a closer look at that. So as seen from the table on the left-hand side, you'll find that, hey, global manufacturing cycle or manufacturing PMI across both EMs as well as DMs have rebounded since August and accelerated in the fourth quarter. So while prints in January was rather soft, as can be seen from the box area, we find that the expansion is still largely positive, and there is evidence that a global cyclical recovery is in play. So with regards to other economic indicators, if you were to look at even the services or the composite PMIs, as well as some of this industrial production growth, you'll find that the evidence point to the same thing, where they are pointing to increasing momentum in the global cyclical recovery. So if you can take a look at the right-hand side, and according to history, you'll find that, hey, a cyclical recovery tends to be very robust after a recession or a crisis. So this time around, we expect no difference. And that brings me to my next point. So next slide, please. So overall, for this year, we hold a constructive view on global growth, and we believe a major theme this year will be a vaccine-led cyclical recovery. So our positivity extends to the growth numbers as well, as we are also expecting a above consensus global GDP growth for 2021 at 5.6% year-on-year this year. And if you look at the growth forecast across the different regions, we believe strongly that Asia ex-Japan is likely the growth driver for the year. And the growth outperformance for Asia and Japan will continue to widen as compared to some other regions, such as your Eurozone or your US or even Japan, where I think 2020 they were hit rather badly. So this outperformance in growth itself will tend to drive the equity portfolio flows into those markets with a stronger growth. So next slide. So right here is one of the raging topic these days. So inflation itself is a big topic. So as shown from the chart right here, you can see that while the inflation magnitude differs amongst the major economies, the trend is similar. Inflation itself is picking up, and it's not just a localized event for a particular country, a particular market. It is rather a global one. So with that said, we expect the US core PCE is the matrix that the Federal Reserve look closely at. We expect that to come in around 2 to 2.4%, and that number itself, well, it might not mean anything to some of you guys, but in general, to us, that means that we will likely see a low risk of a runaway inflation. And with that said, this means that the big reflation narrative right now that is happening should dominate markets this year largely, and equity markets may fare decently under this reflationary undercurrent. So next slide. So broadly in this year, we're also expecting that there will be a robust corporate profit recovery this year. So as shown from this chart right here, cyclical markets will lead this recovery. So most of the cyclical markets itself are generally emerging markets, and with the exception of Europe. So of course, if you look at that, a large driver for this EPS recovery will be coming from base effect. But the other main reason is that most of this market itself have a much higher weightage of cyclical sectors such as your financials, your materials, and energy, as well as the industrial sectors, which we believe they should see disproportionately higher EPS rebound for the year, and that itself should drive EPS growth significantly. And if you look at global valuations that have shot up really rapidly over the past couple of quarters, you'll find that, hey, indeed, the recovery for markets since last year's March was largely driven by valuation expansion. So this re-emphasized the importance of earnings, where we believe that strong earnings must come in this year to justify such level of valuations. And with that said, strong earnings can be found in some of these emerging markets as well. So next slide. All right, so broadly, if we were to take a higher level look at the risk backdrop, we'll find that, in fact, several key risks as well as headwinds have subsided. So, for example, a major worry initially was COVID uncertainty as well as US-China tension. So we find that both have actually receded rather significantly lately. And if you look at some of these major event risks that happened over the past few years, I think the major one that stood out was US election. So I think that the fear of the US election and some of the uncertainty that follows are gradually clearing. And for this year itself, we see no major risk, event risks that will rock the asset classes. So that leaves us to one of the last key risks, which is inflation risk. So that itself was initially more like a deflation risk, which soon morphed into some of this inflation concern. But like as I alluded earlier, we believe that this is not a major concern for markets right now, and certainly not a major concern for equity markets. So next slide. So right, if we were to put all things together, you'll find that the macro backdrop itself favors risk assets, and in particular equity markets. So like what I said just now, and like what I went through, we see a couple of factors supporting this thesis. So number one would be robust EPS recovery, and number two would be a supportive policy backdrop. Number three, it is a macro recovery, which is underpinned by your improving growth as well as a reflation undercurrent. And last but certainly not least, will be a milder risk backdrop in this year. So broadly speaking, this setup itself favors equity amongst the other asset classes, and we think it pays to be pro-risk as well as having a pro-cyclical exposure for the year. So next slide. And to really convey and express this view of being pro-risk and pro-cyclical, we believe that two regions within the equity market that stands out to us. So number one is the emerging markets, and number two is the Asia ex-Japan equity markets. So both of them have a favorable outlook, and we do expect strong performance in this year. So next slide. So right now I'll be touching firstly on EM equities before I proceed to Asia Japan equities. So over the next couple of slides, I will go through some of these drivers and why we favor EM equities. So firstly, we see a big cyclical boost to EM economic as well as EM profit recovery. So if you look across the board, you'll find that across history, cyclical recovery in the EM markets tends to be very strong, and especially emerging from the recession or even a crisis, EM GDP growth itself can be above its long-term trend. So I think this is no difference this year as well, and we believe that this GDP growth itself should come in above consensus, and that itself should be a major driver for equity markets. And if you look at corporate earnings itself, that's the same thing. After a crisis or after a recession, the rebound tends to be very strong, and again, it tends to be within the range of 30 to 60%, and a large part of it is actually due to the EM's huge single exposure, which comes in at around 60 to 70% of the entire index. So with that, we do see above a consensus EPS growth for this year as well as the next year, and that should also anchor your EM equity markets moving ahead. So next slide. And overall, within the EM equities, we see that they are highly exposed to various key tailwinds. So number one will be a weak US dollar. So we do believe that US dollar is now in its the onset of its bear market. So that itself should provide strong support for the years ahead. So first and foremost, for the US dollar itself, we think that weak US dollar is very positive for emerging markets. So if you can take a look at the chart on the left-hand side, we'll find a very strong negative correlation whereby whenever the USD weakens, EM equity strengthens. So the weakness for US dollar itself will feed into commodity prices, and we believe that alongside this ongoing supply demand mismatch for most of these commodity complexes, we'll find a very strong thesis that commodity prices should go a lot more high in the years ahead. But so what this means is it is something very, very beneficial for emerging markets. So if you can take a look at the chart on the right, so almost similar to the chart on the left, where we find that, hey, whenever the commodity price rises, EM equity actually benefits significantly. And I think, as mentioned by Gavin earlier, so rising commodity prices will, in the near term, feed back into the corporate earnings, where we find that if you were to look at the relationship between commodity price index versus the EM's corporate earnings, or EM EPS, so you'll find there is quite a strong leading relationship, a leading positive correlation within that. So next slide. Right. So let me move on to Asia Japan equities. So I do know that a big part of Asia Japan equity falls under the EM universe as well, and therefore they are also facing some of the similar tailwinds that the EM equities are. Like I mentioned earlier, EM equities faces. So, but there is quite a good distinction between with Asia Japan equities, is that they're actually backed by stronger macro fundamentals as opposed to some of the other EM areas such as your Latin America or even your EMEA region. So broadly, on a top-down level, we find the very strong macro data in Asia right now. So over the past quarter itself, most of the economic indicators are in fact beating consensus expectations since early October 2020. So that is denoted by the chart on the left-hand side, where the City Economic Surprise Index have actually crossed above zero, and crossing above zero is an indication that more and more economic indicators are actually beating their consensus estimation, and that is a good sign for Asian equities themselves. And if you look at more of a longer term picture, you'll find that in fact we believe that the economic outperformance of for Asia is likely to continue ahead. So early on, you see the GDP chart, the GDP forecast for the different regions. So right now, this is a line chart where it clearly shows that, hey, the Asia ex Japan's growth itself, which is denoted by the purple line, for the next couple of years we continue to believe that it will widen ahead. And with that said, this economic outperformance itself should continue to widen, therefore driving making the equity markets for Asia more attractive relative to some of the other regions on a longer term basis. So next slide. Okay, so right here you see the chart for the earning estimates on a 12-month earning estimates for Asian and Japan equity. So you'll see a very positive message for this chart, where we believe that Asia and Japan equities, on top of leading the global economic growth recovery, it will also lead the global global EPS recovery as well. So the chart right here shows the earning estimates are in fact above pre-COVID level. And if you look at somewhere along July, there is a very, very strong upwards revision since July 2020. And that positive revision has been carried into 2021, and we see a recent acceleration of this, especially after November period, where it is after the US general election, as well as the news from the Pfizer's vaccine side. So that itself is a very telling sign that, hey, fundamentals for Asia and Japan is actually pretty strong, both from the macro perspective as well as a corporate perspective. So next slide. Right, so here within the global equity market itself, our top picks for this global equities are in fact China, Hong Kong, South Korea, Indonesia, and Brazil. But you may notice that over the past few days or last week, in fact, Hong Kong and Brazilian equity took a hit lately. But after reevaluating our thesis and why they were hit that bad over the past couple of days, we believe that the fundamental aspect of these two markets are still intact and in fact still relatively attractive. So on top of that, if you look at things from a contrarian perspective, you'll find that some of this recent sell-off itself in fact helps to clear away the froth in these markets. So that itself can be very beneficial for investors when you're looking at this couple of markets. So with that said, we do believe that opportunities for 2021 lie within the emerging market as well as some of these Asia ex-Japan equities. And broadly speaking, EM Asia, however, still offers a better risk-reward profile at the current moment. So, but investors themselves shouldn't disregard the other regions because they can and they should diversify into EMX Asia, especially when the global recovery as well as the vaccination program gathers pace. I think when that happens, the risk reward profile will be much better for these markets, especially from the risk side. So because of that, I think we also broadly see attractive opportunities within the EMX Asia region, such as your Brazil as well as your Russia, which are very good, I think, cyclical plays as well as commodity plays. So I think those who some of these markets itself stands out, particularly in the early business cycle. I think the macro setup for is quite perfect for a couple of these markets. But with that said, I think these are our top equity markets, and I want to reiterate the idea that I think to best play this pro cyclical as well as pro risk exposure for this year, I think the best way to do it is through Asia ex-Japan as well as some of these EM markets. But I think when the economic growth picks up, the investors themselves can diversify into EMX Asia. So I think that is one of our key messages. And with that, I come to the end of my presentation right here. So I think with that, I should hand the time back to Deepali. So Deepali, please.
Hi, Colin. Thank you so much. Colin, we do have time for one quick question from the audience. The question is the market expensive considering the EPS of 2022? Can you give us a quick answer to this, please?
Hi. Broadly, if you look at markets in general, as in the global markets as a whole, they are looking at slightly frothy. So I think that is something that we cannot escape from. That markets are indeed looking slightly expensive, but I think we have to segregate markets through the cyclical markets as well as the less cyclical markets. I think if you look at cyclical markets through the lens of more of a multi-year EPS recovery, then itself it look more attractive when it comes to valuation, because valuation for this year might be expensive, but we are in fact, like I mentioned earlier in my slides, in fact expecting strong EPS recovery for the next 2 to 3 years. So early on, also like I mentioned, in the early phase of the business cycle, the EPS growth can be very strong and can tend to surprise to the upside. So once all that fits back into your PE, if you're using that as a convention denominator for valuation, you'll find that if valuations from a longer term perspective is in fact more attractive for some of these markets. And therefore, I think if you were to look at things from this perspective and taking a slightly longer time frame, you'll find a better answer to that question. Yeah.
Thank you, Colin. I think that's a fair answer. We need to take a longer term view of things right now. Thank you so much for your insightful session, Colin.
Thank you.